What if I told you that two people could make the exact same return on their investments in retirement, but end up with two completely different situations financially? My name is Noah Tillinghast, and I founded Callidus Capital to help retirees maximize consistent, stable retirement income. So this is called sequence of returns risk, and in this graphic you can see, take the initial balance. They had if you started with $1 million in scenario A, which is with the loss first. Let's say you retire. You're 65, and you're like, I'm out. So you retire, the market's at a peak, and there's a 50% market decline in year one. And this is obviously an extreme example to demonstrate the point. But then you withdraw $500,000. The balance after that withdrawal is zero. You have zero. Now, in year two, the market goes up 100%. Now, if you hadn't made that withdrawal, you would be back at $1 million. But since you're in retirement, since you're withdrawing from your assets, you're only at zero. Now, let's take this other scenario. In scenario B, with the gain first. Let's say year one, it's a raging bull market, you get a 100% return. These are obviously very high, but it is to demonstrate a point. The withdrawal of $500K comes, and you have $1.5 million. Now in year two, the market declines by 50%, and you leave with $750K. So if you look at that, in scenario A, you have nothing. In scenario B, you have $750K. Now, this is assuming withdrawal. If there was no withdrawal, let's say this is before retirement, the end result would be $1 million. $2 million cut in half is $1 million. $500K doubled is $1 million. So in retirement, if let's say the first 10 years of retirement, let's say you're retired, and it's the market returns essentially what it did from the year 2000. So basically, you're flat, inflation adjusted, for like the price return of the S&P took until 2017. So you're basically just cutting dividends till then. In inflation adjusted, it took until 2017 to recover, and it took until 2013 non-inflation adjusted for you to make any money. So if you retire at a time like that, that's going to completely derail your retirement. And we're going to cover a couple strategies to help mitigate that. The first strategy is the bucket strategy. Having the short-term bucket, 1 to 4 years. It could be like 1 to 3 years or 1 to 2 years. You'd need to figure that out for your exact situation. But in the short-term bucket, you have cash and cash equivalents. And you know that you don't care what the market does. In this scenario, the market declined by 50%. You still had cash. When you made the withdrawal, it was from cash. Your portfolio did not decline by nearly as much because you had cash in it. You don't care what the market does in the short term. By year two, you've already recovered. That's why you have the short-term balance. The medium-term balance is to replenish the short-term balance. This is 5 to 10 years. Take, for instance, the scenario we discussed of retiring in 2000. So this will get you to 2004. Markets have recovered somewhat, depending on the portion of your portfolio that you had. Your tech stocks have not recovered at all because they were still dumping from the internet bubble peak. But markets have recovered somewhat. You're going to have some gains in the bond portion of your portfolio because rates had dumped. This will also hold like shorter term bonds that are maturing and dividend stocks. So you can replenish the short term balance from there. And then you have the long term balance. Now, in a short term market crash, like in 1 year where your portfolio declines by 50%, obviously not common, the long-term portion of your balance, after, let's say, 4 or 5 years, or even like 2 or 3 years, you'll have stocks that have dramatically outperformed, and you made a lot of money on. And you can trim those back to their target weights and move the proceeds into the short and medium term to replenish them. And you can sell other positions as well, but just to replenish the short and medium term balances. And you won't be doing it at fire sale prices. You'll be doing it you'll be rebalancing, albeit not at the best price, but at a good price. And the next strategy is with this doesn't preclude the bucket strategy, but if you vary your withdrawal rate, let's say for instance the market declines by 50%, maybe you say, we'll take a vacation, we'll wait till markets recover, and we'll take it next year. Now, if you have the money to do it, this can end up being a horrible decision in your retirement, and you end up wishing you went down that vacation. So, varying your withdrawal rate can have some benefits. However, it can backfire, and it could be worth avoiding. Discuss with your financial advisor personally, but if you, let's say there's a big purchase, maybe you were considering buying a new car, maybe you wait a little. The final strategy to help limit this is Social Security. So this is a chart of Social Security benefit growth. Now, if you wait until 70 to claim your Social Security benefit, that can help replenish income that you would have needed to draw from your portfolio with Social Security. Now, there are benefits and downsides to this. For instance, you'll have to draw more from your portfolio if you don't draw from Social Security in the beginning of your retirement, when you're waiting to draw Social Security. So this could actually be the opposite strategy that you want to take here, but it's really, these are three strategies: the bucket strategy, the cutting spending strategy, and the Social Security delaying strategy, or Social Security management strategy, that you can use. If you're interested in more videos like this, then you can click on the channel and see more. And please like and subscribe. If you're interested in talking to us about these strategies, there's my contact information and an email list you can sign up for in the description. Thanks for watching.